The Reserve Bank raised interest rates last week, but it also suggested there were going to be more rate rises. So today we discuss what that means for our property markets. Does it really mean property values are going to plummet like some pessimists are suggesting? We also discuss the rental markets, the latest refinance figures, and what the auction markets are suggesting is ahead for property. If you want to keep up to date with our property markets, please subscribe to this YouTube channel and click the little bell icon so we let you know each time a new show comes out. The big news for our property markets and the economy over the last week wasn't the Reserve Bank's 0.25% increase in official rates. That was anticipated by most economists, but what surprised the markets was the Reserve Bank's commentary that Australia can expect at least 2 more interest rate rises. But the Reserve Bank appears to favour a slow and steady approach rather than more supersized hikes. Now, this is because the bank expects inflation to remain higher than in its previous forecasts. Of course, this has brought out the property pessimists again predicting a further 10% fall in property values. But what does this really mean for our property markets? That's what I want to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael. How are you? And another interesting week in property.
Well, there's always news, isn't there? Now, yes. The Reserve Bank statement came out on Friday. That's their statement of monetary policy, and that's their quarterly guide into the bank's thinking and their forecasts. And the Reserve Bank reiterated it expects further interest rate increases, with the plural, will be needed to ensure high inflation doesn't hang around too much longer. What are your thoughts on this?
Well, I think there was a little bit more of a pessimistic tone to the comments that the Reserve Bank governor made last Tuesday, Michael. There was no mention of a possible pause coming through as one of the options. It was all about controlling inflation and that there would be more rises. I think that the latest inflation data maybe was disappointing for the Reserve Bank. In fact, it wasn't just the headline data, again, being the highest that we've seen since the 1990s, early 1990s, and the underlying inflation was another record. Underlying inflation is tracking at around 6.9%, which is way ahead of the 2.3% target that the Reserve Bank is searching for. I think that what we saw in the latest inflation data, which is December quarter, so a little backward looking, of course, at this point of time, but was that we're starting to see prices rise in the service sectors. And I think that reflects those wage increases that are now becoming a catalyst for employers to increase their services costs or prices because their costs are increasing. I think that's a concern for the Reserve Bank because it does, in a sense, portend the perhaps start of a wages prices outbreak. I think that on the basis of that they've they're just going to continue until they see some signs that their targets are being met. Long way from it now, of course. What they're concerned is that they go hard early or hard or high for a long period of time and that cracks the economy. The economy, even though maybe we've probably reached the peak of our labour market performance, but what a peak it is, Michael. We can't complain about 3.5% unemployment rates and near record participation rates. It's a very, very strong economy. Wages data are out soon, and that'll start to push up towards 4% annualised wages growth. So a lack of workers is certainly working its way into higher wages, but again, we're spending that. Retail sales, even though they fell over December, was more that November-December relationship, which has changed now, and numbers are still quite high. So I think the Reserve Bank is the position now where they can't see any signs that an interest rate increases over 2022 every month. 3% higher official rates have had any impact on the targets that they have set themselves. So the conundrum for them is that by the time we do start to see, or they start to see higher interest rates working, it might be too late to save the economy from a downturn. So I think that even though they're committed to higher rates, I think they're a little bit more circumspect now than in previous periods of higher rates in regard to protecting the economy. And I think this is an atmospheric that's being shared amongst central bankers in similar jurisdictions. And I think they're like, maybe we've got to live with a little higher inflation than our targets. And if it means keeping people in work and wages rising.
Well, the Reserve Bank has suggested that underlying inflation is going to remain high. not just this year, but also next year in 2024. And it will take a while to fall back into their target range of 2 to 3%, which suggests, as you say, that they're not going to go too hard. It's that balancing act, isn't it? Each month, My Housing Market comes out with the latest rental report, and the year has begun with record high rents, Andrew.
Yes, Michael, it's interesting. Of course, this is the January data. And January is the quietest month of the year for the rental market. Of course, there's not a lot of moves that are going on. People are on holiday. They're distracted. We have lower numbers of tenants seeking properties. But even given that significant seasonal effect, we did see rents rising still in Melbourne and Sydney over January, which is quite interesting. You know, rents were a little softer in some of the other capitals, perhaps reflecting those seasonal impacts, but it does show continuing high demand and low supply of rental properties, particularly in our big capitals of Sydney and Melbourne, and with other capitals are confronting now surging immigration or new migrant levels, and of course adds to demand for rental properties in an already undersupplied market. We're now also seeing a potential surge anyway, in student numbers coming back into Melbourne. China's borders are open now. The Chinese government's even encouraging students to go and do face-to-face courses in other countries. And of course, Australia is a favoured destination for Chinese students. So once again, that will add more demand in an undersupplied rental market. But it was interesting, Michael, that we did see rents rising for both houses and units over January in Melbourne and Sydney. And when we look at the annual data again, we're seeing these really unbelievable results. With rents in Brisbane, house rents are up nearly 28% over the year in Brisbane, and unit rents up 25% in Sydney, 22% in Melbourne over the year. No surprise there, because those markets, Melbourne and Sydney unit markets, are coming from a lower base, because they were the one, I guess, rental areas where there was more supply than demand, but that's changed quickly over the last 6 months or so. Rents are rising to catch up with that period of subdued demand in those unit markets in Melbourne and Sydney. And of course, that will continue with those demand drivers, as I've discussed before, particularly migration. Vacancy rates just ticked up, are certainly still quite low everywhere, Michael. Anything under 2.5% really is starting to favour landlords in terms of higher rents and more competition for property. And we can see that it's only the Melbourne market with units that maintains a vacancy rate above 1%, but it's falling sharply and has collapsed really over the last year or so, again reflecting how those inner city units in Melbourne are being soaked up. So really no good news. There was a little bit of easing in vacancy rates in some of the smaller markets, Brisbane, Adelaide and Perth, Michael, over January, but once again, that does reflect the normal seasonal impacts of the January rental market.
As we keep saying, there's no end in sight to this, because even though there's lots of new approvals for apartment towers, they're currently not financially viable to build. That's what we've got to wait for the market to eventually work its way through the cycle and prices to increase.
Yeah, and that's a good point, Michael, because conversations with developers recently are suggesting that a lot of the approvals that have come through for apartments particularly are being shelved now because they can't be maintained, because building costs are still rising, which is a concern. And this is impacting the viability of some of these projects. So I think we're going to see a much lower proportion of building approvals converting into commencements. And this is just another negative for supplying an already chronic undersupplied housing market.
One of the things we look at each month is the finance approvals, because it gives us a leading indicator into what's ahead. Now, if you break it down, there's new approvals and there's also refinancing. Yes. And it seems that a lot of Australians are approaching their mortgage brokers and banks to refinance their loans at the moment, Andrew.
Yeah, interesting. The latest data, Michael, shows that even though the absolute number of refinancing that occurred over December fell, it was still the second highest on record behind the November data. So I think that the outlook with higher interest rates, concern that they'll get even higher, has bringing forward particularly those that refinanced in very high numbers a couple of years ago because of those very low fixed rates that were on offer then, and are now facing having to refinance those particular loans that were taken out a couple of years ago, and obviously having to pay a significantly higher interest rate. I think that they're getting in a little early perhaps, and these are signs that those with refinancing rising again over the past couple of months that they're getting in early. I know brokers are sticking close to their clients, a smart move to get them good deals to either move into a variable environment or to fix their rates again. And I think the motivation, of course, is that the Reserve Bank continues to signal that interest rates will get higher. So regardless of the exit fees, I think that savvy mortgagees are moving into the market now to get some deals before interest rates get even higher. And I think the interesting point, Michael, is when we look at the market share of refinancing, even though total numbers fell marginally over December, when we look at the proportion that refinancing is taking up when we look at the total market inclusive of owner-occupied new loans, we can see that the actual market share for refinancing increased to a record 56.6% of all lending, well, owner-occupied lending, for increased over December. So I think that's another sign that we're getting a rising number of refinancing to offset higher mortgage rates as they come through over the next few months.
And I guess that means that the mortgage cliff that some people are talking about is less likely to occur. We've got a much more informed market. I just wanted to interrupt this week's Property Insider Chat to remind you that this is not specific property advice because we don't know your personal circumstances. But if, like many property investors, you're wondering what's the right thing to do at present, should you buy, should you sell, should you wait, you can trust the team at Metropole to provide you with direction, guidance and wealth-producing results. Whether you're a beginner or an experienced investor, at times like we're currently experiencing, you need an advisor who takes a holistic approach to your wealth creation, and that's exactly what you get from the multi-award-winning team at Metropole. We help our clients safely grow, protect and pass on their wealth to future generations through a range of services: strategic property advice, buyer's agency, wealth advisory, property management, renovations and development management services. Go to metropole.com.au and explore your options with the complimentary Clarity consultation. Now, one of the other things we look at every week is the auction results. They started the year really well a couple of weekends ago, so it was interesting to see what would happen this weekend as more stock came on the market, and there was the interest rate increase. But the market seemed to have shrugged it off, Andrew.
Well, I think the housing markets have generally shrugged off those interest rate increases since May last year, Michael. We certainly had a revitalisation of housing market activity through spring last year. Winter was, obviously a typical winter, but exacerbated by those higher rates and perhaps a lack of confidence and all those doomsayer headlines that were infecting the media through the early part of winter last year. And there was the question mark, well, okay, we finished the year better perhaps than many predicted, with clearance rates at around about the 60% mark in December, just above 60%. But the markets have roared back into life this year, Michael. Last weekend or the weekend before last was the first real weekend of the auction season, the first weekend in February, and we got some big results, particularly Sydney and Melbourne, which were over 70%, which was 10% higher than where they finished at the end of last year, which is quite a remarkable result, particularly historically, because nothing really changes from December to February, Michael, in terms of the real economy. But I think it's just starting to see more of that pent-up demand from a subdued market in the middle of last year being released. And I think that, generally consumers are shrugging off the higher interest rate environment, particularly given how strong the economy is, particularly given the highest wage increases we've seen in a decade. So, of course, after those strong results to start the year, Michael, as you suggested, it was interesting to see whether they could be consolidated this weekend. We had certainly, as usual, of course, the second weekend of the year, a surge in listing numbers. Sydney over 500 auctions at the weekend, which was quite a solid number for this time of the year. Melbourne just under 500. But the Sydney market kept on keeping on, Michael, an almost identical clearance rate at the weekend in Sydney, again over 70%. And that's clearly signalling the early part of a seller's market, more competition from buyers for the number of properties available. And even though these numbers are still below where we were a year ago, we've got to remember a year ago, we were still enjoying, perhaps, I don't know if that's the right word, enjoying a very strong period of activity coming off the back end of a remarkable boom period in 2021. So these numbers really do stack up. But again, when we look at how we finished the market last year, these are well ahead. Even the Melbourne market that tracked back perhaps a little surprisingly in terms of its clearance rate, but still well ahead of where it finished at the end of last year. But the other markets were all an improvement, Michael, on the previous weekend. So it was only really the Melbourne market that tracked backwards compared to the opening season. I think this is a very strong portent for the housing market going forward generally. And I don't know what the data is that's supporting these, again, quite problematic predictions of price falls. We're seeing auction clearance rates clearly at the level where we would expect to see prices growth, even with that Melbourne market at 63%. And I still believe that the Melbourne market has plenty of upside this year, particularly driven by what will be, again, it reinforcing itself as the key destination for migration in the country.
Well, these predictions are often made by people in Martin Street and Collins Street. They're not on the ground, Andrew, and hearing the sentiment, feeling the sentiment, seeing the people at the open for inspections, seeing the multiple bidders registering for auctions. So it's actually a combination of data and science. And if you go just on the data and don't actually feel what's going on the ground, you really can misinterpret what's happening, can't you?
Auction clearance rates are remarkably, use that word a few times today, remarkably robust indicator of prices growth. The charts as we show here from period to period are quite clear that higher auction clearance rates mean higher prices. And this isn't just the My Housing Market data that's showing these results. All other data providers are showing similar auction clearance rate results. And of course, we only produce at My Housing Market auction clearance rates based on actual sales. So, we don't have any not for publications in our data. So we know that we can justify every sale that is reported. And I think that gives us at least that sense of reliability in our data.
We'll also break it down by state and by region. So if people want to have the latest information each Sunday, go to LinkedIn, Dr. Andrew Wilson's LinkedIn, and I'll leave a link in the show notes about that. But also we report it on Property Update. So it's not just overall, you actually even break it down by regions and by houses and units, which really is much more important for the big cities.
Well, that's right, Michael. And as I suggested, this data is, in fact, it's a very big jump from, the end of the year to the beginning of the year, and quite a remarkable change, to have lifted at that degree. And I do think it shows that there's plenty of confidence in the market. I think consumers are not only shrugging off rate rises, but they're ignoring the doomsayers. And once again, I don't know how they're going to justify their mistakes, those that are making the same predictions that were all proved to be wrong really over the last 3 or 4 years. But the auction clearance rates data, if you are a dove, if you are a bull in terms of housing market outlooks, couldn't be better to start the year, Michael.
Well, there's lots of pieces to the property puzzle, and each week we get together and try and make some sense of them. So I look forward to catching up with you again next week, Andrew.
Yeah, thanks very much, Michael.